Have you ever wondered how consulting firms make their money? What systems and financial structures allow them to generate a profit? In 2020, Deloitte, one of the largest consultancies in the world, amassed revenues of $47.3 billion. Accenture generated over $44 billion, and KPMG published almost $30 billion in earnings. To get some framework, if Deloitte was a country, it would be approximately the 90th richest country in the world in terms of GDP. But how is this possible? What is the financial flow of capital inherent to the consultancy business that allows them to generate these exorbitant revenues? That is what we're gonna look at now. In the second video of the consultancy series, I will focus on analyzing the business model of these companies, their revenues, their costs, and how they generate profit. But first, let me thank you for watching Rebel Economics. This series on the consultancy industry is very special to me, since I have been working as a consultant for the last 5 years, and I understand why people are so confused about it, since I was too before seeing it from the inside. If you're enjoying the content so far, we would be very grateful if you could hit the like button and consider subscribing. And with that being said, let's get into the video. So, as we mentioned in the first video of the series, there are 3 key players in the consultancy business. There is the client, which generally is a company in need of support in some area that extends outside of its operational focus. Then there is the consulting company, which is the entity that actually offers the consulting services to the client. And there are the actual consultants, the knowledge professionals that worked at the consulting company and are responsible to guide and advise the client. In terms of cash flow and exchanges, the structure is quite straightforward. From the point of view of the consulting company, the client pays the consulting company for the service of the consultants and receives service for it. The consultants offer their time to the consulting company, which then allocates them into projects and clients, and in return, they receive a compensation in the form of a salary. Now, of course, consulting companies have other expenses that we will look at in more detail, but at its most basic level, this is the structure underlying the consulting business. Now let's look at this cash flow in more detail. It is important to mention that when discussing the cash flow of this industry, I am going to be using the hourly revenue model for consulting companies, which basically assumes that clients purchase consultancy hours from the consulting firm instead of buying something like a predefined service package. The reason why I decided to use the hourly revenue is twofold. Firstly, because it is more clear, since comparing price per hour is easier than trying to extrapolate the value and cost of predefined goods and services. Secondly, most of these pre-packaged services are generally priced based on the underlying hours that consultants will work on them. So essentially, they are also based on the hourly revenue model, but with an extra layer on top. So let's get to it. The first step in analyzing any company's expenses and revenues is to split those two into variable and fixed costs and revenues. The fixed cost of revenue is one that is recurrent and independent of how the business performs that year. For example, payments to rent offices. A variable cost or revenue, conversely, is one financial inflow or outflow of money that is dependent on how the business performs. For example, more clients, more revenue. Let's look first at the fixed cost for a company. Here we have the bulk of expenses that the firm would have to pay. For example, rent and mortgage payments on the rented office space. This would include everything related to the maintenance of physical spaces, such as paying for utilities, etc. Also, I would include here the salaries of the consultants working for the company. Some of you might be thinking, but won't those vary based on the number of hired consultants? And that is correct, but my logic is that regardless of whether there are many clients or none at all, the firm would still have to pay its consultants. Also here need to be another expenses from maintaining necessary cost centers in the company. And I define a cost center in a company as everyone that is not billing hours to a client. So we have here the HR department, the administrative department, basically every person in the company that does not bill hours to clients or is responsible for generating new deals. Here are also expenses in publicity and legal services. Then, regarding variable costs, a consulting firm would only really have to deal with bonuses and extra payments to its workforce, which are strictly tied to operational performance. And now let's look at fixed revenues. And here is where we see how unbalanced the consulting business model is. Generally speaking, and considering the aforementioned hourly revenue model, the consulting firm cannot expect any fixed revenues. Its main source of revenue is selling hours to clients, which is tied to the performance of the business and the output it produces. Now, it's important to note that in order to reduce the risk of dealing exclusively with variable revenues, many consulting firms, especially the large ones, will work with multi-year contracts with clients. This has the benefit of bringing in, more likely, more money for the company. But it also stabilizes the risky nature of the natural balance of this industry, in which costs are guaranteed but revenues are variable. So payments from clients will have to go to the variable revenues. And that is basically it. An argument could be made for some or other inclusions here and there, but in a nutshell, this is how the consulting business is structured. Just bear in mind that this is obviously an oversimplification for explicative purposes. So, looking at this business model and revenue and cost structure, the hourly price differential which underlies the consulting business model becomes apparent. The hourly price differential is the difference between the hourly salary paid by the consulting firm to its consultants and the hourly rates charged to the clients for those same consultants. Basically, for the consultancy firm to turn a profit, the hourly salary of consultants must remain below what they pay to charge clients. But this is not so simple. Seeing as how most of the fixed costs the consulting firms has to pay need to be reflected in that price, we need to add some changes to the simple formula. A percentage of fixed costs and payments to cost center expenses will also have to be integrated in the price paid per hour that the consulting firm will face. This will drive the price per hour that the client pays up. Now, the difference between these two hourly prices will be the actual profit for the company, which could be used for future investing or for further hiring. And we're through. I hope it wasn't too much, but it's important to understand the way that consulting firms make money. So, what did we learn today? We reviewed the cash flows within the three key players of the consulting business model. We analyzed the expenses and revenues of a consulting firm, and we understood the reasons behind the hourly price premium paid by clients. I really hope you enjoyed the second video in the consulting series, and I hope I will see you in the next one, where we will talk about the different types of consulting services. So thank you for watching Rebel Economics. If you have not yet checked the first video in this series about just what the hell consultancies are, now it would be a good time to do so, since the upcoming videos in the series will assume that knowledge. If instead you need a little bit of a breather after so many fixed and variable costs, I completely understand, and would recommend you to watch this video on how Google is taking over the health sector. Once again, thank you for dropping by, and I'll see you in the next one.